Okay. Good evening. Good evening, dear students. How are we all? Good evening, Pawan. Good evening, Tanvi. Good evening, Sunil. Good evening, Bhumika. Okay. Now, so we were into the chapter of cost of capital, and we have discussed how to calculate weighted average cost of capital or total cost of capital or overall cost of capital, right? Um, so that was essentially calculated by taking weights based on the amount of investment. Those amounts were converted into weights, and then we simply took the total of the products, right? Then we started with individual items, cost of debt, in which we first had the debenture, irredeemable debenture. So irredeemable debenture is supposed to be calculated by using formula of interest upon net proceeds, but we made it after tax figure by taking it as interest into 1 minus t upon net proceeds. Okay. Then cost of redeemable debentures were calculated as interest into 1 minus t plus RV minus NP upon N and divided by RV plus NP by 2. Okay. Cost of preference shares, we say it is preference dividend by net proceeds. And similar for redeemable preference share, it is preference dividend plus redemption value minus net proceeds upon N, the whole divided by redemption value plus net proceeds by 2. After that, we discussed how to calculate the cost of debt using IRR or YTM method, right? So using internal rate of return or YTM method. So here 0, we have cash flows of, so we just did it as like, if you're investing something, if you're borrowing something and repayment is happening on a, right? So it was like, what was the amount paid? And then we simply use the amount is equal to P into 1 plus I raised to N. And this was working. I mean, this particular formula of A is equal to P into 1 plus I raised to N was working to calculate the value of I until, it was just two cash flows. That is one cash flow happening today and one cash flow happening on a future day. Right? But this actually doesn't work when we have multiple cash flows. Right? So when we are having multiple cash flows, calculating the cost of equity and cost of debt of preference shares, it was not functioning because there were two future cash flows and one present cash flow. So the two future cash flows that we had, they were discounted at the respective rate for 1 year and 2 year. And of course, we got this typical equation. Now, solving this equation, using pen paper mode, it's not at all easy. It forms a quadratic equation. Going ahead, it may become a cubic equation, right? Or and as the number of years increases, the complexity of the equations keep on increasing. So to avoid that, what we generally do is we take the assumed rate to be something. We try to calculate the LHS and we try to calculate the RHS value, equating the RHS with LHS, equating the RHS with LHS. That is 1023.91 we got, but we wanted it to be 1000. So what we did is we took a higher rate, which is instead of 12%, we took a rate of 17%. We got it as 942, and then we just interpolated. We just discussed that when we are changing the rate from 12 to 17, so we were observing that the rate was changing by 5%, and the value was changing from 1023 to 942.65. So the difference between these two was happening for a 5% change. So we wanted the change to be like from 1023.91 to 1000, from 1023 to 1000. So it's like 23.91, right? So 23.91 is the required change. And then we simply did the cross multiplication to obtain the percentage change required. That percentage change was added to the base rate to arrive at the cost of debt using IRR method. Right? I think this is what we have discussed in the previous class. Now let us take it forward for further discussion. We are yet to look at the next type of cost of capital, which is cost of equity. So let's get started with cost of equity. Hello? So, I think yeah. Cost of equity. Yeah. Cost of equity is going to be computed using different approaches. So there are in total four approaches which we are going to observe while calculating the cost of equity. Now, what are those four approaches? Now, understand when we look at cost of equity, are the equity shareholders really telling you what is their required rate of return explicitly? Like, do we really promise some fixed rate of return that we are supposed to be giving to the equity shareholders? Do we promise any fixed rate of return? No. Does that mean that equity shareholders are not to be given any return? Does that mean we don't have to provide any sort of rate of return to our equity shareholders? Of course not. In fact, what do you think the return which an equity shareholder would expect? Should it be higher than the return required by the debenture holder, or lower than the return required by the debenture holder? What should be the return required by our equity shareholders? Higher than that or lower than that? Yep. So what do you think? Whether equity shareholders require a return which is higher than the cost of debt or which is lower than the cost of debt? Yeah, of course it has to be higher, right? So remember, your cost of debt, cost of equity is the highest cost. Now, why do we say that cost of debt is going to be the highest one? Because as equity shareholders undertake highest risk, right? So K is going to be the highest cost as equity shareholders are undertaking the highest risk when you compare with other sort of investors, which are debenture holders and preference shareholders, and therefore cost of equity generally going to be higher. But we don't provide any rate of return to our equity shareholders on an explicit basis. We don't give it in writing that this is the rate of return which a equity shareholder is going to earn, right? So how do we measure as to what is the rate of return required by the equity shareholders? Equity shareholders don't say in explicitly. They're not going to tell you in words. Rather, they're going to express their opinion on the basis of action. So therefore, there are four approaches. There are four approaches to calculate the cost of equity. Let me just put them for calculation. Okay, so four approaches. First is constant earnings model. Second approach is constant dividend model. Third is constant dividend growth model. And last is capital asset pricing model. Okay. Now, what are the formula for this? Constant earnings model says that your cost of equity will be EPS upon market price per share, which is nothing but the earnings upon P0. So cost of equity under this constant earnings model is earnings that you're having on a per share basis and divided by price, divided by the current market price of the P0. Okay. So EPS upon NPS, that is E upon P, that is the cost of equity. So now, like for example, I'll just tell you how is this going to be. Company declares earnings per share and company is observing some market per share amount. So let's say in one of the years, company declared that it has earned a earnings per share of 3 rupees. Company declared an earnings per share of 3 rupees. And let's say at that time, the market price per share was 15 rupees. Next time, company declared a earnings per share of 4 rupees. The market price became 20. Next time, the company declared a dividend. Company declared an earnings per share of 2.5. The market price was 12.5. Then next time the company declared that EPS is 3.5. It's a 3.5. Then the market price per share turned out to be 17.5. So based on this, what can you understand? What is the expected rate of return of the equity shareholders? How much return are the equity shareholders expecting? How much return are the equity shareholders expecting? See, when the EPS was declared to be 3, the market price was trading at 15. So EPS was, can I say, 20% of NPS. And that 20% rule is applicable in each of these cases, in every of these cases, right? So NPS is applicable in each of these cases. So if I ask you, what is the cost of equity from here? 1 second. Yeah. So if I ask you, what is the cost of equity looking at this particular number? Cost of equity is, can I say it is 20%? Right. So cost of equity stands as what? 20% in our case. In this case, cost of equity is 20% because we observe that every time your market price is 5 times of EPS. Your market price is every time 5 times of EPS. It means EPS is 1/5 of NPS. So equity shareholders expect a rate of return of 20% from your particular shares. Okay. Then constant dividend model. Now, constant dividend model is similar to this constant earnings, wherein this model says that cost of equity and equity shareholders require a rate of return, which is going to be dividend per share upon market price per share, right? Or you call it as simply D upon P0. So here we are looking only at dividend as a sort of return with the equity shareholders getting, right? But then we have a more improved version of the cost of equity, which is K is equal to, equity shareholders are not interested in only one stagnant rate of dividend. Rather, they want a growth in dividend, and therefore we say it is D1 upon P0 plus growth. So equity shareholder doesn't require only this rate of return, which is the next year dividend upon the price that you're putting in today, but rather equity shareholder require additionally growth over and above that. So G is the growth rate. You can say G is the growth rate in dividend. right? G is the growth rate in dividend, right? G is the growth rate in dividend, and this is typically computed. I mean, growth rate is typically going to be computed as B into R, where B is retention ratio and R is return on equity. Right? So constant dividend growth model is B1 upon P0 plus G, where growth rate is computed as B into R. B is what? Retention ratio, and R is the return on equity. Okay, so this growth is additionally what is required by the equity investor. Then we definitely have the capital asset pricing model. But let's just discuss that capital asset pricing model as A is, tell me what is the bare minimum return any investor will require? How much minimum return would an investor require? Any investor, I'm not talking from the perspective of equity shareholder, but in general sense, what is the rate of return which you require at the minimum? Yep. Tell me, what's the minimum rate of return which you as an investor would need? I'm not talking in terms of percentage. I'm just asking you to give me a reference. I'm just asking you to give me references. We will need at least, can I say, a risk-free return? At least the return which you can get by investing in bank FDs or maybe by investing in government securities, right? If you have funds with you, you will definitely be asking for a rate of return which is at least, which is at least risk-free rate of return, which is your riskless return that you get from generally bank investment, right? So equity shareholder will also require risk-free rate, right? And we will also need, apart from risk-free rate, right? Apart from risk-free rate, we will need something additional also. Now, what is that additional? Additionally, over and above the risk-free rate, we need a risk premium, right? So apart from just, apart from just risk-free, we'll need something additional, and that's your risk-free, risk premium, right? Correct. So risk-free plus, we need a risk premium, right? So we need risk-free plus some amount of risk premium. Now, that particular risk premium which we are talking of, risk premium, is it a fixed number? Do you think risk premium is a fixed number? Like suppose in bank FD, if you're putting your money into bank FD, you're getting 6%, right? So risk free is, let's say, 6%. Okay, this is fixed. But risk premium, is it fixed? No. On what does it depend? Risk premium depends on what? How much extra return you require, that depends on what? How much extra return you need due to risk, that depends on, can I say, the amount of risk that is there? That depends on the amount of risk that is there, right? Right? So, therefore, we say it is risk-free rate is RF plus beta into RM minus RF. Now, beta here is a measure of systematic risk. Beta is a measure of systematic risk, right? So beta is a measure of systematic risk, that is risk as compared to the risk, how much is going to be the, compared to the market, how much risky is our security. And of course, as we say, the risk-free rate RF is the risk-free rate RM is rate of return in market, right? So for example, suppose for example, if you're saying risk-free rate, RM and all these things, suppose the risk-free rate is 6%, beta is 2, and market rate of return is, let's say, 10%. So can you tell me what is the market risk premium? What is the market risk premium? Tell me, guys. If your risk rate is 6%, beta is 2, RM is 10%, what is the market risk premium? How much extra return are you getting by investing in the market? How much is the extra return that you're getting by investing in the market? How much is the extra return you're getting? Can I say it is RM minus RF, which is 10% minus 6%, that is 4%. So market risk premium is RM minus RF, which is 10% minus 6%, that's equal to 4%, right? Now, do you think that this 4% would come to you without any risk? Do you think that this 4% that you're getting from the market as a whole, from a market on an average, is it coming free of cost? No. Obviously, there is some amount of risk. Now, as compared to the market, if I say that my stock is risky to some extent, like in our case, beta, this simply means that the stock is twice as risky as market. Beta equal to 2, we say stock is twice as risky as the market. So now if I'm saying that my stock is double riskier, my stock is 2 times riskier than the market. If my stock is 2 times riskier than the market, how much risk premium we would require from the security? Risk premium from security. I'm saying that the stock is double risky than the market. Obviously, I should be getting double of market risk premium, right? So which is nothing but beta into RM minus RF. So beta is 2 into 4%, which is 8%. So beta into RM minus RF, that is 2 into 4%, which is 8%. So how much return we should get? Return to be earned by equity investor. Will the equity investor ask for only 8% return? No. Equity investor is definitely going to ask the return. So anyways, I would have got the return as 6% without any risk. Plus additionally risk premium that I should get is 8%. Which is nothing but RF plus beta into RM minus RF. Okay. That's the return to be earned by the equity investor, or that's a formula for K. This is the fourth approach. So there are 4 different approaches to calculate the cost of equity. First, MPS, and earnings per share upon market price per share. Or second is dividend per share upon market price per share. Or you make a dividend growth in it, which is K equal to D1 upon P0 plus G. Right? And then capital asset pricing model, CAPM, that is going to be RF plus beta into RM minus RF. Are we clear, guys? Are we clear with this formula? 4 formulae to calculate the cost of equity. Are we good? Everyone? Yes? Okay. Now, we can say generally, cost of equity is going to be same as cost of reserves, as reserves belong to equity shareholders. So whatever is the cost that you are going to incur on the new equity shares, that's going to be the same thing which you need to be paying on reserves, because reserves are ultimately the money of equity shareholders which you haven't paid out. It refers to the the amount of profits or their return which you haven't paid out. And therefore, we say that K is equal to KR as a reserves belonging to the equity shareholder. So cost of equity and cost of reserves are generally going to be one and the same thing. Okay, fine. So we have seen how to calculate cost of debt, cost of preference share, cost of equity, cost of reserves. We have also seen how to calculate the weighted average cost of capital. Now, let us just take it forward with some questions on this cost of capital. Okay, so just give me a moment. Let me get some questions for you. Question. Try out this question number 1, guys. Yeah, try this question 1. A company issues 10 lakh, 12% debentures of rupees 100 each. The debentures are redeemable after expiry of fixed period of 7 years. The company is in 35% tax bracket. So what we need is the cost of debt after tax if debentures are issued at par, at 10% discount, or at 10% premium. So these are like three different cases where we can say issued at par, 10% discount, and 10% premium. So here we need to look at what is the net proceeds. So net proceeds is obviously going to be 100. 10% discounts, that's going to be 90. If it's 10% premium, that's 610. The redemption value, of course, we assume it is going to be redeemed at par. Interest is 12, right? Is 7. And tax rate is given as 0.35. So we have interest, we have tax rate, we have redemption value, we have net proceeds, we have the number of years. You can definitely calculate the formula or calculate the value of cost of debt using our formula. So what's the cost of debt? Cost of debt is interest into 1 minus T plus RV minus NP by N, the whole divided by RV plus NP by 2. Okay. So use this formula and try to get the answer, guys. Give me the answer for all the 3 sub questions. So first case, that's going to be interest is 12. 12 into 1 minus 0.35 plus, we're looking at par wala case. At par case, cost of debt is 12 into 1 minus 0.35 plus redemption value is 100 minus net proceeds is 100 divided by 7 upon 100 plus 100 divided by 2. So how much is the answer for the first case? So for the first case, the answer is 12 into 0.65, which is 7.8%. Did we get the answer? 7.8%. Yeah, 7.8%. Did we get this answer, guys? Cost of debt as 7.8% for the first case. That is when you are issuing the shares at par. Same way, calculating the second one, when it is being issued at 10% premium, there the cost of debt will be 12 into 1 minus 0.35 plus redemption value is 100 minus issue price is 90 divided by 7, the whole divided by 100 plus 90 divided by 2. If you are getting this, like, I think it should be getting answer 0.078. 0.078 is 7.8 out of 100. So you can simply write 7.8%. Okay, alternative, you can multiply by 100 and write the answer as 7.8% also. Either ways, it is fine. What is the second answer? Second is 6.7%. Is it 6.7 or more than that? Second one. Second is like 12 into 0.35. 0.65. 12 into 0.65, which is 7.8 plus 10 divided by 7, which is 1.43 upon 95, which is 7.8 plus 1.43 divided by 95, which is 9.72%. Right? 9.72%. What's the answer for third one, guys? Third answer for cost of debt. Yep. What is the answer for the third question? 8.7. Let me just verify. Third is going to be like KD is equal to 12 into 1 minus 0.35 plus RV is 100 minus 110 upon 7, the whole divided by 100 plus 110 divided by 2. So this is 12 into 0.65, which is 7.8, then 100 plus 100 minus 110 divided by 7. So this is 7.8 minus 1.43 upon 105. 7.8 minus 1.43 divided by 105. So answer is 6.06%. Right? 6.06%. Twelve into 0.65, that's 7.8. And then this is going to be like 100 minus 110. So minus 1.43. And that will give you answer is 6.06%. Perfect. Okay, so we got this answer for question number 1. Now, Try out these questions, guys. The second question. Try to solve this question. Question number 2. Try to solve question number 2. Are we trying these questions? Initial 6 questions. So this is perpetual, right? Then you have uh, redeemable at par. 10-year later, this is 10-year later preference share, equity share with some amount of dividend growth, and then also 6 questions. So try out these 6 questions, guys, quickly. Try out these 6 questions. Yep. What's the answer for first one? Perpetual 15% debt of rupees 1,000 sold at a premium of 10% with no flotation cost. What's the formula for this cost of debt? Since this is a perpetual cost of debt, there's a perpetual, right? So here we can say cost of debt is interest into 1 minus t upon net proceeds. So apply the formula and get the answer, guys. So for all the 6 questions, let me just give you some time. Yeah, 6 minutes for all the 6 questions. Yep, try it out quickly, guys. First answer is 8.86. Second answer. What's the answer for second one? Second 9.36. Okay. Now, coming to the third one. Third one is a bit different. They say 14% preferential redeemable at a premium of 5% with 5% flotation cost, dividend taxes 10%. Okay. So how are we going to do that? See, let me take this question over there. Okay. 10-year 14% preference share. So if it's 14% preference share, we can say preference dividend is 14. Net proceeds redeemable at a premium of 5% with 5% flotation cost. So flotation cost is 5%. So net proceeds will be 100 minus 5% of 100 because you have a flotation cost of 5%. So that's going to be issued at 95. The redemption value is also at a premium of 5%. So that's going to be like at 105. Number of years is 10. And dividend distribution tax is given as 10%. Now, in case of preference dividend, in case of preference shares, the dividend that you pay, you're not going to get any deduction for that. Rather, you need to pay the tax of your investor from your pocket. So, preference dividend, this is payable to preference shareholder. Dividend distribution tax, this is payable to government. Right? So preference dividend is payable to preference shareholder. Dividend distribution tax is payable to government. So total cost is going to be preference dividend plus preference dividend into DDT or dividend distribution tax. So this is like total dividend cost. So preference dividend is 14 plus 14 into dividend distribution tax is 10%. That's like 14 plus 1.4, which is 15.4. The total dividend is going to be 15.4. Okay. So now when we're calculating the cost of preference shares, it's going to be 15.4 plus redemption value is 105 minus net proceeds is 95 divided by number of years is 10. The whole divided by 105 plus 95 by 2, which is 15.4 plus 1 upon 100. So 16.4 upon 100. Answer is 16.4%. Did we get it, guys? Did we understand the third question? Third question is like, along with your preference dividend, you need to pay 10% of that as tax to government. That is also an outflow for us. Therefore, we consider that also into our cost calculation. Are we good, everyone? Flotation cost is deducted from issue price. Yes. Flotation cost is basically your expenses that you incur to pay to raise capital from the market. Okay. Is it clear? Yes. Okay. Then try out the next question. Fourth, fifth, and sixth. Third, fourth, fifth, and sixth question. Flotation cost is 2000 minus flotation cost is, I mean, in net proceeds will be, okay, redemption is at par. So 2000 is the redemption value minus flotation cost is 5%. So 2000 minus 5% is 1900. This divided by 10. And then this is 2000 plus 1900 by 2. Hmm. If you do this, what's the answer? So 2000 minus 1900 divided by 10, which is 10 to 140 into 0.65, which is 91 plus 10 divided by 1950. So 91 plus 10 divided by 1950. One second, there's some problem. Then it'll be 140, yes. 280, no? So that's 280 into 0.65, which is 182. Yeah. So 182 plus 10, 190 divided by 1950, which is 9.84. 9.84 or 9.85%. Correct. Okay. Look at the fourth question now. Fourth question, an equity share selling at rupees 50 each. Equity share selling at rupees 50 each, which is market price per share is 50, and paying a dividend of rupees 6 per share. So dividend is 6, which is expected to continue indefinitely. This is a constant dividend model, wherein we say cost of equity will be simply dividend upon market price per share. The dividend is 6 upon market price is 50. So 6 divided by 50, which is 12%. Right? If the dividends are expected to grow at the rate of 5%, then how is it going to be different? If dividends will grow at 5%, K will be D1 upon P0 plus G. So if dividends are expected to grow at the rate of 5%. Now, if dividend is going to grow at the rate of 5%, we can say it was paying a dividend of rupees 6. So the next year dividend will be 6 into 1.0. It is 5%. 1.05 upon current market price is 50 plus 0.05. That's 6 into 1.05. 6.3 divided by 50. 0.126 plus 0.05, which is 17.6%. Like 12%. No, but it has to be growing, right? Because the 6 of dividend, selling at 15, paying a dividend of rupees 6. So this is the dividend which you have paid in the previous year. So next year you will be obviously paying 5% extra dividend. So I've taken that additional dividend into our calculation. And therefore it is 17.6%. Got it? Did you get it, guys? Point 0.05, where is it given? 5% is a growth rate, right? You have a growth rate of 5%. So 6 plus 6 into 0.05, so that is 6 into 1.05. So to give the effect of that 5% growth rate, we are multiplying it with 1.05. Did you get it? Yeah. Now, sixth question. Equity share is selling at rupees 120 per share. We have the market price or P0 is equal to 120. The EPS is rupees 20, of which 50% is paid as dividend. So we have EPS as 20. Dividend per share is 50% of 20, which is 10. So dividend per share is 50% of 20, which is 10. Now, EPS of 20, of which 50% is paid and dividend, the shareholder expects the company to earn a constant tax rate of 10%. So, constant rate, growing at a constant rate of 10%. So, if it is growing at a constant rate of 10%, D1 is going to be D0 into 1.1 because it's going to grow at 10%, which expects to, okay, this is a different thing, sorry. Yeah, so the shareholder expects the company to earn a constant at a rate of 10% of the retained earnings. So here, this is a case of we need to get the growth rate. So growth rate is going to be calculated as B into R. B is your retention ratio. R is return on equity. Now, this retention ratio, B, which is a retention ratio, that is 50%, right? Because 50% is paid out, so 50% is retained, which is 0.5. Multiplied by return on investment is 10%. So growth rate is going to be 5%. So we can say dividend for next year will be 10 into 1.05 because it's going to grow at 5% next year. So that's becoming 10.5. That's D1. Then cost of equity will be D1 upon P0 plus G. So D1 is 10.5 upon P0 is 120 plus G is 0.05. Yeah. So how much is this? That's 13.75%, right? And here is 13.75%. Are we getting this 13.75%, guys? %. Okay. So great. Now let's look at this question number 5, guys. And question number 5, they've asked us to calculate the weighted average cost of capital using book value and market value rates. Now, what are these weighted values? Weighted average that we'll see later on. But right now, we have got 3 sources of funds. One is debenture, second is preference share, and third is equity shares. Okay, so all the securities are traded. All the securities are traded in a capital market. Recent prices. So current market price of debenture is given, preference share is given, and equity shares are given. Anticipated external financing opportunities are as follows. 100 per debenture redeemable at par, 20-year maturity, 8% coupon rate, 4% coupon, sale price is 100. Same way, rupees 100 preference share redeemable at par, 15 years to maturity, 10% dividend rate, 5% flotation cost, sale price is 100. Right? And then equity shares are given, which is rupees 2% flotation cost, sale price is 22. The flotation cost is 2, which is going to be subtracted from the sale price. In addition, dividend expected at the end of the year. So this is D1. Growth rate is 5% as a growth rate. And the firm has a practice of paying all its earnings in the form of dividend corporate tax rate is 50%. Okay. So we have to calculate individually. You give me the number of, you may give me the calculations of cost of debt, cost of preference share, and cost of equity. I need these three individual numbers from your numbers. Try to calculate the individual cost of capital. So you got it. Cost of debt, cost of preferential, and cost of equity. Okay, perfect. So when looking at this particular aspect, cost of debt will be 8% coupon rate. So 8 plus RV is 100 minus net process is 96 divided by 20, and then whole divided by 100 plus 96 by 2. First answer, I mean, if there is a tax rate given, tax rate is 50%. Okay, so this is able to be 8 into 0.5. Yeah, so answer is 4.28. Are we getting answer is 4.28%, everyone? Cost of debt, 4.28. Cost of preference share will be 10 plus 5% flotation cost, and then redemption is 100. So 100 minus flotation cost after deducting flotation cost, it has 95 upon 15 years to maturity, and then whole divided by 100 plus 95 by 2. And again, this 10 needs to be multiplied by half of it. So that is 5.4%. Cost of equity is going to be dividend, expected dividend on equity side at the end of 2 is 2 per share. So it is like 2 upon current market price is 20, plus it is going to grow at 5% every time. So that is 15%. Cost of equity is going to be 15% because the sale price is 22, but when there's a flotation cost of 2 rupees. So if you're going to issue the equity shares, you will not be able to get 22, rather you will be getting only 20. Okay. Did we get this all three answers, guys? 4.28, 5.54, and 15%. Previous one we have added. Where did we add? Here they are saying the dividend expected on equity shares. So when you say dividend expected, that is next year dividend. That is already after adding this number is there. Right? If it would have been like dividend paid in the previous year, then you would add the growth rate into it. But when you're already given a dividend rate which is for the next year, right? Then of course you need not subtract it separately. You need not multiply it with 1.05. Are we clear? Everyone? It's 2 upon 20 plus 0.05, that's 15%, right? Now we have got individually cost of debt, cost of preferential, and cost of equity. Now we have to get the weighted average cost. Now for the weighted average cost, this is the amount of capital given. Now for this capital given, we can definitely say the capital book value. Capital is debentures, preference share capital, and equity share capital. So book values are given to be 8 lakh, 2 lakhs, and 10 lakh. You can get the weights. Cost is something that you have computed, and we can simply take weights into cost. So this is totaling 20 lakhs. So weights are going to be like 0.4, 0.1, and 0.5. So these three are the weights. And the cost that we have computed, cost of capital that we have computed is 4.28, 5.4, 4.28, 5.4, and 10%. So simply take the weights into cost and give me the total value wise. This is our weighted average cost of capital on book value basis. The weighted average cost of capital on a book value basis. Give me this total answer. I mean, give me the weighted average cost of capital number. Yep, 4.28 into 0.4. 0.28 into 0.4. 1.712. Then 0.1 into 5.4. 0.54. 0.5 into 0.15. 0.075. If you just take a total, 1.712 plus 0.54 plus 0.075. This is 2 point. Book value basis, it is 2.327. Take a second. Some problem. Should be 7.5. Yes. 0.712. 0.54 plus 7.5. Yeah, that's 9.75. Okay, so this is one aspect. दूसरा है, this is what we've got weighted average cost of capital on book value basis. Now, weighted average cost of capital on market value basis. So when we say market value basis, we'll say this particular portion, this capital and book value, are obviously going to remain same. Capital and book value. Capital is debt, preference share capital, equity share capital. Book value is 8 lakh, 2 lakh, 10 lakh. We need the market value of each one of them. What's the market value given in the question? Market value is like debentures are trading at 110. If debentures are trading at 110, market value of debentures with a book value of 8 lakh will be 8 lakh 80,000. Then rupees 10 preferences are trading at 120. So if it is 20, this should be 2 lakh 40,000. Equity shares are trading at 22. So that's going to be 22 lakhs. I mean, 10 lakh is the count. So, yeah, 20, this value is 10 each, right? So, there will be 22 lakhs. Take a total of it is 8 lakh 80,000 plus 2 lakh 40,000 plus 22 lakh. 33 lakh 20,000. You take the weights, cost, and then weights into cost. So complete this table. Give me the, this number is also WAC, is also weighted average cost of capital, but on market value basis. Are the answers going to be same? No. Obviously, answers are going to be different. Which one of them is more accurate? Both of them are accurate in their own way. If you want to see what is the cost on the basis of the book value of the total funds, then you use the first method. If you want to know what is the market expectation, then you go for the second method. So what are the weights number? 8,80,000 divided by 33,20,000, which is 0.2651. Then 2,40,000 divided by 33,20,000, 0.0723. And then the last one is was 22 lakhs divided by 33 lakh 20,000. So 0.6627. The other weights. We can write down the cost as we have computed: 4.28%, 5.4%, and 15%. So just multiply weights with cost. 0.2651 into 4.28, which is 1.13. 5.47 into 0.0723, 0.395, and then 0.6627 into 15. This works out to be 9.94. And if you add all of that, 1.13 plus 0.395 plus 9.94, that's 11.465. That's the weighted average cost of capital on market value basis. Okay, are we getting it? It's a market value basis, weighted average cost of capital on a market value basis. Yes. So when the question asks you to compute weighted average cost of capital on market value basis, just try to make it like whatever the book value is, just convert that into market value, and then the simple calculation is remaining the same. Further calculation remains the same. 0.9 for second one, no, 3.9. It is 5.4 into 0.07. 5.4 into 0.07. 0.3, 0.723, 0.39. Okay. Are you following how to calculate the weighted average cost of capital on market value basis, everyone? Did we get it? How to calculate WACC on market value basis. Okay. Fine. So then let's take a break now, break of around 15 minutes. And then we'll come back and do more questions on this weighted average cost of capital. Let's take a break next. Shall we continue, guys? Yeah. Okay. So let's go for the next question now, guys. Let's try out this question number. Question number 7. Question 7. I want you to calculate from this question 7. ABC has the following book value capital structure. So remember, the values that are given to us over here are all book value based. Okay. So we have equity share capital, reserves and surplus, 10.5% preference share capital, which is 100 million, 9.5% debentures, which is 1500 million, 8.5% term loans from financial institutions, which is amounting to 500 million. Now, debentures are redeemable after 3 years and are quoting at 981.05 per debenture. Applicable income tax rate for the company is 35%. The current market price per equity share is 60. Prevailing, now remember, this 981.05. This is going to be your net proceeds. That's your tax rate. Current market price per equity share, this is P0. Prevailing default risk-free rate on a 10-year government bond is, this is your risk-free rate. Market risk premium, this 8% is RM minus RF. And this is, of course, beta. Preferred stock is redeemable after 5 years. So it is N 98.15. That is again net proceeds for preference shares. So first, I want you to calculate the cost of debt, cost of preference shares, cost of equity, and cost of term loan. Right? So first, calculate these 4 items, guys. Give me these 4 items. All the numbers I have highlighted, you should be able to get it easily. Try to answer this and try to solve this. Get me these numbers. It's 4 numbers. Because only after that we'll be able to understand, we'll be able to calculate the weighted average cost. Yes. What's the cost of debt, cost of preference share, and cost of equity, guys? At least cost of debt. Can you tell me what's the cost of debt? Cost of debentures I'm talking of. When I say debt, it is cost of debentures. Cost of debt is 6.87. Okay, let me just check. Solution file. It's 6.87. किधर किधर हो गया? 6.87 is correct. Then given the cost of preference share, what's the cost of preference share is? Of preference share. So just check, you can get this cost of equity, cost of debentures, cost of term loan, and cost of preference share. Just verify. So you can see cost of debt for debentures is 6.87 as you get. Cost of equity, did we all get it as 15%? Cost of equity is 15%. Cost of term loan is 5.53 and cost of preference share is 10.97. Just check if you're getting these four numbers of cost of capital. Cost of debt or debentures, that was 6.87%. Cost of preference share was 10.97%. Cost of equity is 15%, and cost of term loan is 5.53%. Right. Okay, so just verify if these are the four answers you're getting, or anyone, any number which are not able to get it. Just confirm the cost of preference share, cost of equity, and the cost of term loan. Let's check if you're getting these numbers. Are you getting these numbers? Can we go for the weighted average number then? Can we go for the weighted average cost of capital calculation now? Because we have to take the market value weights. So market value weight is nothing different than book value. It's just that you need to convert the book values into market values, right? Correct. So have so this is like equity. We can say equity is what, 1,500. So 150 is the number of shares. 150 is the number of shares multiplied by each share is valued at 60 rupees. So the market value will be obtained in that way. Then debentures are valued at, when trading in market, at 981.05. That is into 1.5 million debentures. Preference shares are 98.15 into 1 million. Right? That will give you market value. So once you have the market values, then weights, you multiply it with the cost and get the product. So you already have the cost of equity. We have the cost of debt. We have the cost of term loan. We have the cost of preference. So just substitute it and get the weighted average number, guys. Get the weighted average cost of capital. KE doubt. So what's the doubt in the KE? In KE, they have given us the risk-free rate as 5.5. RM minus RF is 8%, right? And the beta is 1.1875. Beta is 1.1875. That's already given. So you just get it as RF plus beta into RM minus RF. Okay. In case of reserves, there's no separate market value. And therefore, we are not going to consider it in our calculation.
Recording stopped.
Okay, I think there was some technical issue. There was logged out. I'll just share the screen again. Get the weighted average cost, please. Give me the weighted average cost. Give me the weighted average cost.
Recording in progress.
Okay. So 0.071. These market values should be these numbers, and the weights will be this. Check out the weights. It will be like 9,000 out of 11,069.73, 0.1329 out of 11,069.73. To get these weightages, we already know the cost because that's what we have already computed. Just you have to take the product and take the total. Take the product and take the total, guys. The weighted average cost of capital is 13.46. Perfect. Now, let's go for the second part of the question. Let me share the screen again. There's some network issue ongoing. The second part of the question says, we have to define the marginal cost of capital schedule. Now, marginal means, of course, we're talking about some extra cost of capital. Extra cost of capital for the firm if it raises 750 million. So if you're going to raise 750 million for a new project, the firm plans to have a target debt to value ratio of 20%. Define the marginal cost of capital schedule for the firm if it raises 750 million for a new project. Right. So this is for a 750 million for a new project. The firm plans to have a target debt to value ratio of 20%. So debt to value ratio should be of 20%, which means out of total capital, 20% should be debt. Right. So out of total capital, 20% should be debt. The beta of new project is 1.4375. So you got the beta. The debt capital can be raised through term loan. Now the term loan, say it carries an interest rate of 9.5% for the first 100 million and 10% for the next 50 million. Okay, so I want you to look at this particular portion and give me the cost of debt number. Give me the cost of debt for this, guys. And obviously you take the tax rate to be same, 35%. So taking the tax rate to be same, 5%. I want you to calculate the cost of debt first. Can you tell me what will be the cost of debt in this case? And of course, you can get the cost of equity because this is your new beta. This is going to be the new beta. What will be the new beta? As per new beta, the cost of equity will be cost of equity as per new beta is going to be same 5.5% plus 1.4375 into 8%. That will give you answer as 17%. Whereas cost of debt, it will be computed in a bit different way. This is going to be like 9.5% for initial 100. 9.5% for initial 100 plus 10% for 50 multiplied by 1 minus 0.35. Right. So 9.5% into 100 plus 10% into 50 multiplied by 1 minus 0.35, which is the 1 minus tax. So this is the interest upon net proceeds answer. So interest is 9.5% of initial 100, 10% of the remaining 50. On that, you multiply 1 minus 0.35, the whole divided by 150. That should give us answer as 6.28%. Now, once we have this 17% and 6.28, we can get the weighted average number also as 14.86%. Yeah, just go through this solution and check if you are able to answer it. This is clear to you, everyone? Just go for it for a couple of minutes. Okay. Then let's go for one more question. Okay. Uh, yeah. Try out this question number 6 now, guys. Try to solve this question number 6. Solve this question number 6, guys. Okay. Will be raised to define weighted marginal cost of capital if it raises 10 crores next year. So we need to raise 10 crores next year. How are we going to raise it? We are going to raise it by way of debt equity. The amount will be raised in equal proportion. So out of 10 crores, can I say 5 will be debt, 5 will be equity? 5 crore will be debt and 5 crore is going to be equity. The company expects to retain 1.5 crore earnings next year. Okay, the company is expecting to retain 1.5 crore earnings next year. 1.5 crores earnings is going to be retained. So can I say out of the 5 crore equity, 1.5 crore is by way of retained earnings. The additional issue of equity shares will result in a net price per share being fixed at 32. The expected dividend. Now, when they say expected dividend of 3.6, what is this 3.6? Is this 3.6 D1 or is it D0? Can I say it is D1? Yes, because it's the expected dividend is 3.6. The dividend per share is expected to grow at the rate of 7%. So from this, you can definitely get the cost of equity. What is cost of equity then? How much is the cost of equity? Can you tell me what's the cost of equity, guys? Of equity? That's going to be 3.6. Of equity will be calculated as 3.6 divided by market price of 32 plus 0.07 being the growth rate, right? So that's 18.25%, right? 3.6 divided by 32 plus 0.07, that's 18.25%. Okay, so 18.25%. Now, then we have the cost of debt. Cost of debt will be raised by way of two areas. One is going to cost 15%. 9 बजे तक तो yeah, debt capital will be raised by way of term loan, which will cost 15% for the first 2.5 crores and 16% for the next 2.5 crores. Income tax rate is 40%, guys. So when we say debt capital is going to be raised, 2.5% on 2.5%, on 2.5 crores, you will have 15% interest. And on the next 2.5, you'll have 16%. So get the cost of debt, everyone. Get the cost of debt from this. It will be simple. You take the total interest, which is 15% of 2.5 crores plus 16% of the remaining 2.5 crores. That's 77 lakh 50,000. So it will be like cost of debt will be 77 lakh 50,000 into 1 minus 0.4 divided by 5 crores. So just go through this. Interest, then cost of debt, there will be 7 lakhs into after tax effect, and then you just take out the weighted average cost of capital. Yes. So got this, everyone. Question 6 solution. Are you able to get this? Are we getting this, guys? So these are like where you are raising debt, but not fully from one source. You are raising it from multiple sources. So when you're having multiple sources, you need to get the total of all the interest, make it after tax figure, and then calculate the cost of debt accordingly. Okay. So if you have any queries, you can post it now with regards to whatever discussion we had. I'll put up some more extra questions and solutions for practice on our portal. You can access it from there. Any queries, guys? Queries? Okay. Then in that case, let's just call it a day, guys. Yeah. So let's stop here for the day, guys. See you in tomorrow's session where we're going to start with a new topic. Okay. Good night, guys. Enjoy. Bye bye. Take care. Bye bye, guys. You're welcome. Shivam. Bye bye. Yes. Bye bye.